There are 13 other callers on the call.
It's so practical and so relevant. Let me just show you a stock which will substantiate my point. So let us go to, can you look at my screen, the Internet Explorer? You can have a look at this, right? Okay, sure, thanks. So let me just, let me go to the stock called, let's go to Google Finance first. And let's go to this stock called Gati. How many people know this company called Gati? Okay, and let us see. Now see this typical graph of this stock called Gati. The price of this stock was hovering around in 2000 and by 2013 end, which is almost December, the price of this stock was hovering around 30, I think it's almost 32, 33. Yeah. If you see, till this time, there was not much activity in the stock because logistics sector is too much dependent on the economic activity, and if the economic activity was absolutely in a slow pace, thanks to the last 5 years, 6 years of rule of the other government, then there was not much happening in this particular stock. But if you see, the moment there was an upsurge in economic activity, or there was expectation of upsurge in economic activity, and also because of very strong upsurge of online purchasing, and where Gati is one of the important players in facilitating the logistics for the online purchasing, there was a significant buying by someone here. The average volume is this. You see, someone bought these stocks at a significant low level, making an estimate of how smart value Gati can add to the logistics sector overall of India. So this guy, actually one of the major buyer of Gati was Ramesh Damani. He is holding 5% stake in this company. So this guy was a smart guy. And this guy is also the promoter of the company who was interested to buy this stock because he realized that the stock is absolutely undervalued. And look at the way this stock has reacted after this. So the stock worth around 30 rupees, accumulated by someone at around 35, it's almost worth 180, 190 rupees today. You know, this is what stock market is all about, and this is the kind of opportunity stock market gives to you if you think like a promoter of a company. So the key here is to think like a promoter, think like a businessman. You know, the typical retail mentality is when everyone is buying, buy, when everyone is selling, sell. But the place where you make money is that to find out what other people are doing and try to be slightly contrarian in your opinion, follow the macro more aggressively, and then obviously you will start thinking like a promoter of a business, and then you will definitely ride the whole stock market rally as a lot of people have been doing for the last 6 months to 1 year. Okay, so pardon these slides which are slightly dated, because the last time this PPT was updated was 2011. I'm going to update it recently. So basically the phases, you can see the clear phases where Nifty is getting peaked, and then there is a bottoming out happening, and then again there is a peak which is happening now. Obviously what is going up today, after a few days it has to come down. Now the point is, who is the one who makes money out of these rallies is the clear winner out here. So there is a bull market, there is a bear market, and there is obviously a sideways market. Bull market is obviously when the market is going up, it's bull. When the market goes down, can anyone tell me? I'm very curious to know if someone knows about it. Why market going up is called bull market, and why market going down is called bear market? Any idea? Anyone? Any idea? This time I will allow you to speak as well. So if anyone has any idea, I'll open up his mic.
Well, yeah, I can comment on this.
Yeah, Ajay?
This is Karan here.
Yeah, Karan, please tell me, why is it called bull market?
Well, I heard somewhere that, the natural reaction of a bull is to pick you up. When you see a bull's reaction, it goes from bottom to up. Whereas if you see a bear's natural action, it's from top to bottom. So probably that was the reason.
Absolutely, absolutely. Bang on. So this is the clear reason why it's called bull market and the bear market. Great. Thanks. Sideways market is typically the market where it does not do anything. It doesn't go up, doesn't go down. But that's the best phase of market to accumulate stocks, identify good ideas and accumulate stocks. Because that's the phase when the market is getting ready for the next big move. I'm trying to skip some presentations which are of no relevance. Yeah, this is extremely important part of our discussion, where why emotions play a very significant role in market, and people who have been able to control their emotions, give scientific reasoning to their emotions, have been able to create wealth for themselves. For example, a typical, everyone knows about it, that a typical retail is very weak in emotions and they will always follow the herd. And wherever herd is, it's very difficult to make money. And a smart guy is always a very cool and calm and very, very good, who has done a very good number of work for himself and who understands market in a much more constructive manner and involved manner. He makes most of the time good money from the market. So there are a lot of bias, and there are a lot of cognitive bias, and there are a lot of emotional biases involved in the market. This is a good field of study if someone wants to take it to the next level, where you understand the whole ecosystem of how we think and how our thought process is controlled by our emotions, and what is the relationship between our emotions and the investment or the trading we do from the market. Okay, let's talk about the market capitalization. What does market capitalization talk about? So market capitalization is essentially, it measures the total value of the business enterprise, obviously from an equity market perspective. And economic value added is another concept which a lot of equity analysts these days use. Economic value added is the market capitalization plus minus debt if company has taken, or cash if company has. So essentially, market capitalization is, suppose if you have 100 shares, if Reliance total 100 shares and the price per share is 1,000, obviously the value of Reliance for you, for all practical purposes, is 1 lakh. So if today you want to buy that company totality, you have to pay a lakh of rupee to buy that company to the promoter. So in terms of classification, why is it important for us to know? There are 3 major, if you can segregate these. There's no scientific or fixed formula for this. It totally depends upon your individual judgment. But some stocks are extremely large cap stocks, some are mid cap stocks, some are small cap stocks. Obviously, a small cap stock will become a large cap stock if everything they do is correct. And your idea of wealth generation will only come if you invest in small cap stock and continue to hold it till it becomes a large cap stock. So these are typical large cap stocks where big guys like Reliance, Infosys, ICICI Bank, and these guys, these promoters of the company, obviously Infosys is an institutional which has been owned by many people, but Narayan Murthy has been face of the company for long now. So these are the large cap stocks, and then you have a mid cap stocks which have the potential to become large cap if they do everything correct for themselves, and if obviously the industry also grows along with them. And small caps are the new guys who have just entered the business domain, not that just entered, means the financial market point of view, have just entered the financial market business domain, and if they grow properly, they have the potential of becoming the mid caps and then the large cap company. There is a concept called free float market cap. Now this is important to be understood. What is a free float market cap? In a very simple sense, free float market cap is the market cap with regards to total free float stock available in the market. So suppose out of 100% shares, 60% share is held by the promoters, 5% shares is held by LIC, and 5% is held by the guys who are related to promoters. So 70% of the stocks is actually not available in the market. Only 30% of the stock is available in the market. Now when you calculate the market cap from a free float perspective, you multiply that 30% of the stock with the market price and arrive at the free float market cap for the company. Okay, what is an index? Now an index is, obviously, it's a report card of an exchange. It's a report card of the economic activity of the balance sheet of India. So basically what you try to do is you select some important companies which can be regarded as a benchmark companies for us, and you use the performance of those companies, accumulate the performance of those companies, and try to make a judgment about the performance of financial sector or financial markets in India. So how do you compute an index? So let us assume that when the Nifty started today, it has only 3 companies with a market cap, market price per share, and total number of shares as mentioned here. So you have Reliance, Infosys, ICICI Bank, these are number of shares and these are market price. So total market cap of Reliance is 1000, Infosys is 300 and ICICI is 500. So the total market cap of Nifty is 1800. This is yesterday, this is today. And the next day, the total market cap, because of change in the market price, the total market cap has increased to 2200. So essentially the Nifty should go up whereas the market cap is going up. Now how do you calculate Nifty? Now Nifty is obviously an index. So you try to create a base for that index. So index simply means anchoring or fixing. So when we assume here is that 1800 is indexed or fixed or assumed to be 1000. This 1800, the value of the index is known as the base market cap. So essentially, if you consider 1000 to be the base of Nifty, so the Nifty price, because it's a concept of normalization, the Nifty price tomorrow should be 1000 multiplied by 2200 divided by 1800, which is 1222. The market cap, the index calculation earlier used to be a pure market cap index calculation, which was changed almost 4-5 years ago in a free float market cap index weightage. So basically, for number of shares which we use in the company for calculation of index, we will now use the free float, and you multiply with the price, you get the market cap for yesterday, you get the market cap for today. Considering Nifty is base of yesterday, obviously Nifty base is not yesterday, Nifty base was formed in almost, I think it's in 1996 or 97. So from that base, you calculate the Nifty price which should be there today and price which should be there tomorrow using these free cap weightages. Okay, let me ask you this, that which company is the largest market capitalization company in India? Do you know this? Which company is the largest market cap company in India? I can see some people doing Google. Yeah, so Anand, you're right. The largest market cap company in India today is TCS. And if you see the way TCS has built wealth for its shareholder in last 10 years, it is absolutely amazing, and it's a delight to see TCS giving this kind of a return to the shareholders. And the second largest company is ONGC, and the third largest company is Reliance. Now, if you see typically globally, commodity companies form one of the important market cap companies for all countries globally. Among the top 5, you'll see a lot of oil drillers or oil petrochemical companies becoming part of the highest market caps in the world. Okay, circuit breaker. I would like to just mention here what circuit breaker is. Basically, the idea came in 1987 when there was a huge Dow Jones crash because there was a lot of electronic trading happening then and there. So there was the introduction of circuit trading there. Basically, the idea is to control the movement of indices or stocks for a particular day. So there is a clear guideline given by the SEBI, as well as there are in some aspects there is a guideline followed by the exchange themselves, which are more internal guidelines, that how much a stock should move in a particular day. And if I suppose a particular circuit has been hit, then what should be the next follow on after one circuit has been hit? Should we open it for another circuit, or this will not open further, there will only be a fixed circuit? So typically in case of index, the circuit is 10%, 15%, 20%, and obviously there is also some timing which has been introduced recently, that if market goes up and down by 10% before 1 p.m., it will be halted for 1 hour and the trading will resume. From 1 to 2:30 p.m., the trading will be halted for half an hour and the trading will resume. After 2:30 p.m., there will no halt in trading at all. So these are basically mechanisms to protect the investor community or to protect an extreme volatility in the market so that people get enough time to exit and enter the market on a particular price. Okay, so this is the the basics of market. In fact, we have some very nice recorded videos on these topics as part of our SME course. In fact, as part of our beginners course as well, which is there hosted in our website. So this is a video which my discussion is more impromptu and more brief. But if you look at that video created by one of the expert faculty, it's much more elaborate and much more hands-on explanation of each and every topic. Today's class was more of a it's meant for people who have already enrolled for our SME online program. People like Sharadipo, Daljit, Somajit, Bhamini, Taru, Venkat. So these people have enrolled for the course and it was more of a doubt clearing session for them. But I preferred to go through the presentation once more for the benefit of other people. So do you have any question till this presentation? And so that I can move to the next part of the presentation. I'll wait for your question. Do you have any question? Oh, that's nice. That means the concepts are very basics and you ought to know these things if you at all are thinking about financial market. So that's nice. Let's go to the next presentation which I have where we talk about the primary market. Okay, let me just gauge some idea about the audience I'm dealing with here. So, so I can see there are 21 participants today. Out of these, is there anyone who doesn't know anything about the financial market or who would like to know from, okay, there is a question which is coming from Farhan. How can we judge the good indicators of the stock market behavior? How can we judge the good indicators of stock market behavior? Okay. See, there are a lot of quantifiable indicators of stock market behavior. Index is one of the most used indicator where you really get to see how stock market is behaving. But apart from that, well, now because the market has become so mature and it's a total efficient market hypothesis which is working in India, you have to move beyond index. So there are stock indices. There are certain quantitative parameters like advanced decline ratio, delivery statistics of market, like out of the total turnover which is happening in the cash market, how much is getting converted into delivery, what kind of bulk deal is happening, what kind of open interest is getting created in the market. So apart from pure index, which gives a bird eye view about where the market is going, but if you really want to analyze the market behavior, you have to get into the sector-wise analysis of what each sector has done. You have to get into what kind of delivery increase or decrease is happening in which sector. So basically a market is a place where there is a flow of fund from one instrument to the other instrument. And you as a market participant, you should be well equipped to understand how to identify that flow of money from one instrument to the other instrument. And that flow can be from gold to equity, from crude oil to soya bean, or it can be from a banking sector to a infrastructure sector. So it totally depends upon what is the situation of economy right now, what is the policy framework where we are operating, which sector is being favored for against which sector in our policy. If you get into all this number crunching in detail, you will have a good idea in totality about the market behavior, specifically if you talk about Indian market. I hope I have answered your question, Farhan. So out of the group which I am talking to, is there anyone who is doing active trading in market? Yes, Karan, please go ahead. See, yeah, Karan. Okay, I mentioned the stock is undervalued, right? And then it moves high, right? Then how do you realize the stage when it is undervalued? Okay. When I was talking to you during that presentation when we mentioned that the stock is undervalued, you're the best guy who will really understand the true value of his stock is the promoter himself. So at that stage, identifying the undervalue. Okay, so that's what I'm saying. A promoter, it's not about inner news or insider news. It's about getting the pulse, feel the pulse of the industry. Karan, you and me, we are not really part of that industry if we operate in a stock market. We can have a look at the industry, we can track the industry by primary research, but a promoter will get such a strong pulse from the market that you and me cannot get the pulse. So he's the first one who gets the feel that, okay, my products are getting sold in the market more aggressively now. And he will be the one who will get inside the stock initially. So that's his definition of undervaluation, because he's thinking not from the stock price perspective, but in terms of what kind of business he is expecting, what kind of business growth he is expecting from the business. Then comes the knowledgeable investors like Rakesh Jinjwala, Ramesh Damani, who believe in a theme, who work with a theme in mind, that okay, because of online, a lot of online purchases, logistics sector will see phenomenal improvement. Now that's a theme which, because they read so much, because they talk to people so much, they get this theme and they build on that theme. Oh, this is a nice theme. Can I identify a company which is good in logistics and which is getting a lot of orders from other players like online guys? Okay, this is a company, Gati is a company, Blue Dart is a company. Okay, now comes the point where you have to make a judgment, which your question is. Now the point comes where you have to make a judgment in whether the price of that instrument, that equity stock is fair price or underpriced. Now there are 2-3 methods of identifying that. The most common method which everyone is using is a peer-to-peer comparison. So what people do is, and that peer-to-peer comparison, Karan, mind you, is not just for India comparison. So what typically, when I interacted with Mr. Ramesh Damani, I saw his theory is that in India, this company called Gati has a market cap of say X $million. And in US, a company called Blue Dart or a company called DHL has market cap of X plus Y $million. Now he makes a comparison between the kind of growth which is expected from India and the growth which is happening in US, the sheer size of business of logistics which is in India vis-a-vis which is in US, and he realizes that in India the market cap of that company, which is one of the good companies in this sector, is only 10% of the market cap of company which is there in US. Now that is an aberration which he believes, and over a period of time because of his experience he has realized that is not a that is not correct, because a company which is showing a country which has similar kind of a growth, much aggressive growth, a country where this particular company is one of the leaders in that industry, it cannot have market capitalization only 10% of the market cap of that company which is there in US. So that's his way of doing peer-to-peer relative valuation. For us, probably we would like to get into some more financial number crunching, where we would like to find out what is the expected revenue and discounting the expected revenue to current market price and see whether the current prevailing market price and the fair price calculated by us, there is any significant difference. If there is any difference, then obviously there is a case for us to buy or sell that stock. So you will always see promoter getting understanding of that business first, and then the smart investors like Ramesh Damani, Rakesh Jhunjhunwalas of the world realize the true potential of that industry, and then eventually you will see the institutions getting interested in that stock, because then it becomes a story for everyone. Right, Karan? Can I request other people to switch off their video, otherwise the bandwidth will become so heavy that it will be, at times it will be difficult for you to capture. Yeah, thanks. Ravi, can you also switch off your video? Thanks. Because it's one to many, so if everyone starts their video, then everyone looks at the other video, so the bandwidth consumption will be extremely heavy. Okay, so let's go to our next topic called primary market. And this is the most important topic for coming 3 to 4, 5 years here. In fact, if you are an investor and if you have surplus fund to invest in market, be ready for a lovely ride in terms of primary market ride, because you will have some lovely IPOs coming into the market, new issues coming into the market, new stocks getting listed in the market, and you will get, as a retail investors, ample opportunity to make money from these IPOs. So what is primary market? As the name suggests, primary market is essentially the market from where the companies would try to garner fund for their initial funds for their operations. It can also include the institutional placements done to QIPs. Okay, we have some question from Daljit. Are you suggesting the world or India? Okay. Daljit, I'm not getting the context of your question. So are you talking about the same question about how to value a company? Are you talking about the same? Okay. So right now we are focusing only on the Indian market, because I think the Indian market offers tremendous opportunity to us to focus. The whole world is focusing on Indian market. So we are talking about primary market only from India perspective right now. But obviously there will be stocks which will issue ADRs and GDRs, which will cater to American or global investors to invest. But it's essentially we are only talking about primary market in India right now. And you will have huge opportunity in primary market in India in terms of new stocks, new ideas coming into the market with their new issues. Okay, so primary market is typically the IPO market or the new issuance market, not necessarily restricted to equity markets. You can have a bond market, a new debt issue which is coming up, or the NCDs or fixed deposit by company. They also come under the branding of, under the gamut of primary market. So the primary market can be a public issue market. That means it can be an IPO or a further follow-on public issue. It can be a private placement, where a company would go to a private institutions to place their shares before they come out with an IPO. Or it can be a preferential issue for some group of individual investors or to some institutions, because the private placement it happens much faster, and it is much more smoother because it doesn't involve too much of public garnering of fund. You can also come out with an issue to existing shareholder in the form of a right issue. So there are existing shareholders, and company can come out with a follow-on issue where they can ask for further funding from the existing shareholders. And obviously, as Daljit we are talking about, that we can also come out, the companies can also come out with the foreign capital issuance like the FCCBs or ADRs or GDRs, and invite foreign investors to invest in their share capital. Again, this is a data slightly delayed, late data, but primary market has not done good for last 3-4 years. Although the issuance sizes have been small, the issuance which came were of decent performance, but now you'll see a lot of new issues coming up which are pending with CB and for approval, and you'll see a huge surge in primary market activity. In fact, in one of the news article I read somewhere, the government has asked all the investment bankers who conduct these primary market issuances to stop to postpone their private company placements for the time being, because government is interested in divesting some of their PSU stake. So they will have to garner fund from the market. So what government has asked these investment bankers to give first a chance to the government enterprises like Coal India to Oil India to divest their shares first, and then the private would be asked to garner money from the market. How do you track the primary market? I'll just show you how do you track. Just go to the if you Google, this is the way so just do NSE India and IPO. You'll get a link, and this link is basically the IPOs which are closed now and the IPO which is expected to come. So Shamiru Entertainment is an IPO which is expected to come on 16th and is going to close on 18th. If you look at the past issues which has been in market, for example, Wonderla Holidays was an issue which came on 21st of April and which closed on 23rd. This issue was for so many shares. It was an initial issue. It was issue price at 125 rupees and the current market price is 315 rupees. So actually this stock has given decent return to the shareholders. Apart from this Loha Ispat, the issue was withdrawn because there was not much interest for this stock. Engineering India came out with an issue in again Feb, and the stock was the initial issue was given 150 rupees. Current stock price is 240 rupees. So these are like new companies coming out with their primary market issues in the market to garner initial fund from the market. So IPO refers to as offering or flotation is when a company called a issuer issues shares to the public for the first time. They are often issued by smaller, younger companies seeking capital to expand, but can also be done by large privately owned companies seeking to become publicly traded. So not necessarily an IPO is always done by small companies. The IPO is actually also at times done by big companies, but who prefer to stay private, because there are obviously a lot of compliances involved once you go public. You have to give a lot of disclosures of financials. So a lot of companies, they prefer to remain private, but after a point of time when they need fund for further expansions, they come out in public domain for public IPO. So there can be big companies also coming out. For example, Coal India was a big company, but they came out with an IPO only 3 to 4 years ago. Why? Because they needed fund to expand their operations further. And obviously, the other intention was also to divest some of the government stake to the public in large. Follow-on offering, or often called the secondary offering, is an issuance of stocks subsequent to companies' IPOs. An offering can either be of two types. Either it can be dilutive offering or the fresh issue. What does this fresh issue talk about? That the company is going to issue further shares to the market, and the overall stock base of the company will go up, thus diluting stake of all the shareholders in the company. Can we explain this? Yes. So if suppose today there are 100 shares in the company and I am holder of 60% of their share, that means I am a 60% shareholder in the company. And suppose I come out with a further new issue of 20 in the from the company to the new shareholders. So the total capital base will increase from 100 to 20 plus 20, which is 120. My stake will remain the same at 60. So my percentage actually reduces from 60% to 50%. So this is your dilution offering of the fresh issue. The other one is a non-dilution of the offer for sale, where the share held by the promoter is given to the market for the purpose of sale. So the stake, the overall capital base of the company remains 100, but I sell out of 60% of my share, I sell 10% to make the shareholding to 50%. Okay, this is clear. This is a slightly old snapshot, but I like this Coal India IPO, so I've kept this. That Coal India came out with an IPO in 2010, and the performance of that IPO has been pretty handsome. One of the major reasons of that IPO was the government wanted to dilute some stake. Not all IPOs will give you money. In fact, when there is too much hype, hysteria in the market, typically IPOs are priced at obnoxious level, where upside from that remains always a challenge. So when the IPO market is booming, when it is just picking up, for example now, you will see the pricing of instrument at a very reasonable level. But once the IPO market is at its peak, you will see pricing of those stocks at an unreasonable level. Reliance Power was a classic example of pricing the IPO at an unreasonable level. There are advantages and disadvantages associated with an IPO, but obviously it offers huge advantage in terms of branding, in terms of taking company to the next level. A public limited company obviously will always have a very strong business orientation, because the kind of branding the IPO will generate, the fact that you're a listed company helps you in a lot of other forms, opens up a lot of gate. And obviously the guys who are giving debt to the company, they become more comfortable when the company gets listed. When you analyze the IPO, see, there are very simple things to do. At times we try to make our life complicated. But if you keep your life very simple, just think like a businessman. कि बस ये business मेरे को करना है, suppose. So if a company is coming out with an IPO, say this company called, okay, let's try to do a case study here. So let's see that today you saw that this Shamru Entertainment has come out with an IPO. Okay, I don't know anything about that company, say for example. So first thing I need to know that as a businessman of Shamru, as an owner of Shamru Entertainment Limited, I want to know what is this company into. So what do they do? So let's see, we go to their website and try to make a judgment about them, that what do they do. Oh, looks like it's a movie company, or it's into Bollywood. It looks like it has its own content, and it sells content both online and offline. Oh, that's interesting. Let us go further in detail. This music is coming from this website only. Okay. So this is a Mumbai-based company. So basically this company is actually into the distribution of media. They have rights of movies and they sell these rights. So the content acquired or produced by us consists of complete ownership rights and limited ownership rights are known as our content library. So basically they are content people who have procured various rights and they are selling those rights to various channels, which can be a DVD, which can be through online, or which can be through a collaboration with distributors like ZTV or Star Plus, and they make advertisement revenue out of it. So this is the predominant business model of this company. Now if, just a minute. Can we see their financials here? So this looks like an old company, because this company okay, let me go to SEBI site, and because SEBI has all the companies who are coming out with an IPO, they have to submit something called a red herring prospectus, which will give total detail about that company, what are they into, what are the financials, who are the promoters. So we should go and search for this company in SEBI website, and if possible we should download the red herring prospectus of this company. Okay, so let's click this. So this is the detailed draft red herring prospectus of the company. So we should download this document, or this is also available as physical copy to any good financial market intermediary who is dealing with the IPO distribution. So you can get this copy from them as well. But if you download this document, so the lead manager, so the company which is managing this issue is Yes Bank and ICICI Securities. These two companies are together managing the issue. and the registrar, the one who is responsible for maintaining the register of shareholders or the applicants, is Linked in Time India Private Limited. Okay. So I've downloaded the PDF. I'm looking at this PDF. Just a minute. Okay, so this is the table of content of this Red Herring prospectus. So if you look at this section, if you want to know more about the company, you go to introduction section. About the industry, you go to the introduction section. About the company, you go to the section number 4. And if you want to get the financial information, go to section number 5. So these are the main sections to know more information about the business of this company. So let me just go to. Okay, how many people have seen this document earlier? These kind of documents earlier, how many people have seen? Anyone who has seen? Oh, first time, Karan. This always looks a very heavy and complicated document, but this is an absolutely pleasure to read document. Because if you really want to know about this industry, what this industry is into, and okay, I think I've crossed that. So there's a detailed Q&A also given by the management. So first you know about the industry, then the company, and then you can come to this Q&A, because it will be easier for you to evaluate this Q&A. So this looks like a complicated big document, but trust me, it's a very good thing to read because you get an understanding of the industry. Now look at the information you get after you read something like this. So you basically get to know about the media and entertainment industry in India, how this has grown over a period of time, the television, the potential of television, DTH, the film industry, how it has grown over a period of time, the effect of social networking, the new media. And this is a business about the business of the company, that it was formed in 1962 in Mumbai as a book circulating library. Today we are an established integrated media content house in India with activities across content acquisition, value additions to content, and content distribution. Together with film-based copyright and other entertainment rights, the brand Shemaru is synonymous with quality entertainment. If you go through this document and then try to understand the business model and try to understand the industry and do a SWOT analysis of this company, that what is the strength, what is the weakness, and then if you have some understanding about the financial engineering, that how this company has done over a period of time, assets, growth in inventory, cash flow analysis, what kind of money they are making, will they have potential to continue making money the way they have been making in the last 2-3 years. So that financial modeling or financial analysis, if you have the capability to do that, trust me, it's not very easy to arrive at the fair price of the stock. And once you make that judgment, either you can buy now, or if you believe that fair price will come back after, you don't believe that today's issue price is a fair price, don't subscribe. And you arrive at a fair price which will be an alert for you whenever that stock reaches that fair price, you buy from the secondary market. It is as simple as that. Reading these documents ultimately helps you to build your knowledge on individual industries. I know stock market is the only place where actually you know about so many industries. When you talk about a specific, talk to some specific industry guy, he will always be focused on his industry. But for us, being part of the stock market, we are exposed to all kind of industries, and these are all documents which help us to get knowledge about the industry. So these are basic documents which are factual documents from the companies, and then beyond these documents there will be a research analyst who will be making detailed research. For example, let's Google if there is any research report on this company by anyone. So research report, this. Okay, so there looks like someone has made a research report. So IPO report is there by someone. SMC Globe Securities, they have come out with their IPO report where they have discussed about this company. So this is now analytics. That okay, the factual thing which is there in the market for everyone to read, that is there. But beyond that, what is now individual analysis of individual research company? If you read those as well, you get a fair idea about how to approach analytics in those companies. Are you getting what I'm trying to say? So actually participating in Indian equity market, or for that matter any equity market, it's not a very complicated thing to do. Yes, when it comes to financial engineering, you have to equip yourself with the tools to do the financial engineering part. But apart from that, if you start believing that you are business owner of that company, automatically you will start thinking logically and with a lot of common sense in mind. And I've already crossed 1 hour of our discussion, but I'll take liberty to take another 20-25 minutes before I conclude my session for today. So you guys, at least as a retail investor or as someone who has knowledge about markets now, because you have attended some of our programs, you should make a sincere effort in going through these IPOs which are coming in the market, because this will help you in getting into the theoretical understanding of industries in India. And then you can obviously give a recommendation about, okay, this stock looks good because they are doing business in this manner, and you can give recommendations to other people to subscribe to the IPOs in these IPOs, if you believe that that industry or the business is good enough for you to understand. So business model of the company, object of the clause, why the fund is collected. Now that is important. You don't want the promoter to take fund from you to build his own house, right? Or you don't want them to take fund from you to buy an office in Marine Drive. You want them to collect fund for some productive purpose so that business growth is been done aggressively. So the object of the issue should be well read properly, and that is there everything in the document. Management of the company. And the core thing of equity market is who is managing the show, who is the businessman. If the businessman is a credible guy with a track record and who has not done something hanky-panky earlier, I think those are the guys you should focus on giving your hard-earned money to, right? And obviously the financials, which is a little bit of financial engineering which you need to learn as someone who understands the pricing of the equity product. See, the process is, in a very simple terms, I would like to state that the process is that you draft a red herring perspective, you submit that to SEBI, which is regulatory authority. They will take you their own time in identifying if there is any problem with that document. In the meanwhile, obviously the whole process you can't do it as a company, so you appoint a merchant banker who is a registered merchant banker with the government or with the regulator, and that merchant banker will do that whole process. You also appoint these days an IPO grading agency just to give a feeler to the retail audience that this IPO has been graded by CRISIL or ICRA in this manner, so that they get an understanding of the grade of the IPO. The initial offer is open for some days, which is available for bidding to the market, and then there is a close date after which the date of listing of the stock is decided, and based on the close date, the issue the shares are allotted to the public in large. Okay, Anubhav is asking me, management can be analyzed for current companies, but how about companies coming with IPO? Okay, that's an interesting question. Anubhav, there are two kinds of management. One is a management which doesn't have any company in the public domain, right? And they typically, when there is a company in a public domain and they come out with an IPO of the other company, you know the track record of the management in the other company which was there in the public domain. So that is fine, there is no problem. But the second point, where there is no track record of the management at all, there are 2-3 things which we have to understand. A, the management qualification, the background of the management, whether they are learned people, whether they are technocrats, whether they have been in this business for a long period of time or not. B, these merchant bankers or investment bankers, they always prefer to take the management for a road show before they come out with an IPO. And the road show is obviously not typically held at a retail level, but there are Institutions like, Motilal Oswal, SMC, Comex, or Goldman Sachs of the world. So all this management will go to those institutions and meet them. And the people, the research analysts in those institutions, they will try to gauge the kind of quality of the management they have. And in the research report, they will mention this, that we met the management. The management has this vision. The management is good in doing this. There's a problem with the management. And based on that transcript, you can make a judgment about the management, because it's very difficult for you to talk to the management. And Anubhav, in today's world of Google and internet everywhere, getting some kind of a background check for anyone is not a challenge these days at all. Imagine a situation where there was no internet and people used to try to find out about the management by going to the state where the management is living, tracking the management, what is he doing, what kind of car he's driving, what kind of dresses, clothes he's wearing, whether he's flamboyant or whether he's down to earth. So all these qualitative aspects used to be a major benchmarking criteria to understand the real character of the management. So I know it's difficult to make a quantitative conclusion, but a very strong gut feeling and your common sense understanding of how a person should be will help you analyze the management properly. See, uske baad bhi, ultimately there is some element of risk involved. So even if you end of the day you did all your homework and you thought management was good, for example, Mr. Raju of Satyam, he was great, he was very nice, but ultimately there was a scam which came out. So you will have to be mentally prepared for some of these things which may happen eventually. But your overall portfolio, that percentage will be significantly low to your overall portfolio, overall experiences in life. Okay. Now, obviously, there is a whole process. I don't want to get into the nitty-gritty of the process. In fact, I would suggest the video which we have by Arshad on IPO. That's a very nice video he has built. So you go through that video and you will understand what the whole process of book building is. But in a very nutshell, I've told you that there is a range which is given by the SEBI that the bidding will be between this and this price, and depending upon the bids which come on the price, there will be allotment to the number of shares. And typically I've seen that the price is typically, when the market is going great, the price is obviously the higher band price, but the market is, when it's poor, it's typically near about the lower band price. So it depends upon the stock and depends upon the IPO. Merchant bankers are typically people who are registered with SEBI to do this merchant banking work, and they have to appoint other intermediaries like the registrar, the printer, the agency, the guys who are going to do the banking, the banker to the offer, etc., to manage the whole show. Prospectus, as I showed you, is a document which is registered with with SEBI and is also submitted to ROC, which is a true reflection of with all the data points, true reflection of the silent features of the IPO. So this is an example which I've already showed you. Foreign issues are basically the instruments which are issued to foreign audience. So FCCBs are the foreign currency convertible bonds. Convertibles are essentially the paper which is issued which has the potential of converting into equity in the later date. ADR, GDRs are basically the American depository receipts or global depository receipts, which helps international investors to subscribe to the Indian shares in dollar terms. There is a concept called ASBA where you don't have to pay the full money in the time of application. What you can do is you can direct the merchant banker to block amount in your bank. The money may still remain with you, but the amount will be blocked. You can't use that amount for any other purpose, but you will keep on continuing enjoying getting the savings rate or whatever bank account you have. Based on that, you keep on enjoying the interest rate in your bank account. Money will not be given till the shares has been allotted to you. Issue date is typically the open date and the close date. Typically the range is between 2 to 3 days the issue is closed. Offer price is basically the range price which is defined, and cutoff price is the final price. It's a final price which is there. which decides the final allotment. Okay, I'm trying to keep it, make it slightly fast here because actually the market of IPO is very straightforward and very known to a lot of people. So I'm just trying to skip this presentation and go to the next presentation, which is I'm going to take probably 10 minutes for this presentation before we end the presentation today. So actually 1 hour is not sufficient enough to discuss everything in detail. I want to touch on the macroeconomics. Okay, let's do something. Let's not discuss macroeconomics right now. I will organize one more session probably next weekend or the weekend after that on purely on macroeconomics, because it really needs a lot of attention, time and discussion. Because here we are not just talking about economics from a theoretical perspective, but the applied economics in financial market. So I think that would need some detailed discussion from our side. So I'm keeping the floor open for any Q&A you have for today's session till date, with a promise that there is one more session which I'm going to plan for macroeconomics, so that you can really see the practical part of how economics affects the financial market over a long period of time. So any question and answer, I'm ready to take some questions, and after that we can close the discussion today. You can, if you want to ask any question, you can just unmute your mic and you can ask question as well. You don't have to post it in the messenger. How a company gets listed to a stock exchange? Okay. So let's answer this question by going to the respective website of a stock exchange. So Aman, NSE is one of the leading stock exchanges in India, right? So what I do essentially is in Google I'll mention NSE India listing. Okay. So all the corporates who have come out with an IPO, they would like to list themselves in the market, in the secondary market, so that those stocks can be actively traded by the people. And there are two stock exchanges where typically listing is happening right now, either NSE or BSE or both. So a company can prefer to list themselves in both the exchanges. NSE plays an important role in helping Indian companies across the equity market by providing a liquid and well-regulated market. NSE has about 1,319 companies listed, representing the length, breadth and diversity of the Indian economy. Now, how is the listing process happen? So there is an application which the company has to make to the exchange that we are interested in listing ourselves. So there is a lot of documentation requirement from the exchange side, and obviously there is an approval which is required from SEBI. A proper due diligence is done by the exchange as well as the regulator, and after proper due diligence, the stock is listed on the exchange. And when the stock is been planned to list on the exchange, there will be announcement done by the exchange to all the members that this stock will be listed on this particular date. Now, an IPO, initial IPO, obviously will get listing formalities done immediately, because there will be seldom a case where a company coming out with an IPO will not get listed. So the whole process of listing will become part of the IPO process. But there are companies which are not listed in one exchange. For example, there is a company which is listed in BSE, and they would like to list themselves in NSE. So they will have to apply to NSE for the purpose of getting listed. And you know, these are different ways. If you go through them, there are different ways companies would be required to apply to get listed in the exchange. Okay. The question is from Ajay is, any comment on technical analysis versus fundamental analysis? Okay. First of all, Ajay, let me tell you that I'm a full-time trader. I trade commodities and currency full-time, and I do track fundamentally the market but my tracking the market fundamentally is very different from fundamental analysis. Karan, I'll get back to you on your question. Can I just answer Ajay first? Okay. So technical analysis is essentially understanding the market from the price behavior perspective, where you presume that all the fundamental factors that can have an effect on the price of the instrument is there in the price itself. So you try to see the liquidity flow in that instrument. You try to see the demand and supply flow in the instrument through pictorial presentation or through analyzing the price behavior. Now this price behavior can be through charts. This price behavior analysis can be through quantitative parameters as well. In the classic technical theory talks about the charts, the chartical part representation of the price behavior. And the modern theory talks about the quantitative, where not necessarily you look at the charts, but you have a lot of quantifiable parameters, which are typically the indicators and oscillators, which helps you to make a judgment about where you're expecting the price to go. Whereas fundamental is really arriving at the fair price of the instrument and then making a judgment whether the instrument is underpriced or overpriced and taking a very strong bet on the pricing of that instrument or the stocks or the commodity or the currency. You know, for some instruments it's practically impossible to do fundamental analysis because these are such a hugely held instruments. For example, gold. How will you do fundamental analysis of gold? And what kind of time frame we are talking about? Are we talking about 5 years, 10 years? What are we expecting the gold prices to be? You know, it's very difficult to make a judgment on those instruments. But equity, yes, you can make a fundamental judgment because you know this company, there's a set limit, there's a set information which is required to understand the company, and you can make a judgment about industry or the promoter or the regulatory. So it's easier to do fundamental on smaller instruments with a set information, but the instruments which are largely owned, like commodity, currency, it's very difficult to make a fundamental judgment on them. So you rely on instruments like technicals, which are more of fair pricing theory of market, where you believe that market price has everything in it, and all I have to do is try to predict the future price movement of market based on the historical price movement. Now the historical price movement can be a 5 minute, 10 minute, 15 minute, 20 minutes, or a day or a week or a month. And the future prediction can obviously be done based on the time frame you take for the historical price movement. Okay? So there's, if I can just summarize this discussion, that a technical analysis essentially is to facilitate trading activities. A fundamental analysis is typically to facilitate investment activities. Whereas in trading also you need some information which are fundamental in nature. For example, data releases. For example, product releases. But those will not have a broader effect on the pricing. Those will not have a broader effect on the value of a stock, which will have a smaller immediate impact on the price of the stock. Karan, okay, your question is, I have a question. Can we sell shares allotted to us on the date of listing itself? Of course, why not? When you have shares with you, it's there in your DP. So in the same day, you can sell your share when the stock is getting listed in the exchange. For example, there's a recent listing which has come up. So we go to NSE India and do an IPO again. So the latest issue which has closed is Snowman Logistics, which got listed yesterday, and that stock has seen 70% appreciation over the closing price of the listing. So a lot of people must have sold their stock yesterday itself. Okay, so so I hope you guys enjoyed today's discussion, and for the benefit of people like Daljit, Sorat, Saumitya, Bhoming, Taru. Okay, Ajay has question and he believes that the question may sound stupid. Ajay, there is no question, there is nothing called stupid question. A question is a question. But can we buy from BSC and sell in NSE? Ajay, you can buy from BSC, but it will take time for that stock to come to your DP. Only after your stock is there in your DP you can sell in NSE. So when you talk about a stock, it is not a BSE stock or an NSE stock, it's a stock. The only time you can sell a stock is when you have that stock in your DP. You cannot sell stock if you don't have it in your DP, or you cannot sell stock by borrowing it for someone else. The borrowing mechanism in India is not well developed, so you will not get an opportunity to sell and buy in the same day. You're getting my point? So if you buy today, you can sell it only after you get it in your DP. We'll spend 5 more minutes on Q&A, and in case you guys still want further questions to be answered, we are obviously very, very open to organize another Q&A session whenever you are comfortable. Even if I'm not there, there are a lot of expert faculty we have who can answer your relevant questions. You can shoot an email to our team and with your requirement, and they will definitely get back to you with their best ability to solve all your questions. You can also go to our website eLearn Markets, and there's a section called ask.elearnmarkets.com. Register yourself there and send us questions there, and our pool of faculty will be obviously hands-on to answer your questions immediately. Okay, Anubhav, I'll take this one, the last question. If an IPO is cancelled once, can it be reapplied? Yes, it can be, but the whole process has to be repeated again. And there are some restrictions, there are some limitations, that after a particular time frame only that applications can be done, the reapplication can be done. But a company once decided to come with an IPO and cancel the IPO, they can obviously come back again with an IPO. Okay, once it has been cancelled from the SEBI side, then obviously it becomes extremely difficult, because SEBI obviously will give a justification about why they cancel the IPO. And if the justification is such that it is not possible for them to re-accept the application, then the company may not apply. But if the company believes that the justification given by SEBI is unreasonable, they can obviously go to a higher regulator like a tribunal and apply and launch a kind of a case against SEBI and try to get a better justification for their cancellation of an IPO, and come back again if tribunal asks SEBI or instructs SEBI to allow the company to come out with an IPO. But there is nothing, yes or no answer to this question. It's a case-to-case basis. If anyone wants to, ask a question without typing, I can keep the floor open. You can just unmute your part and you can ask me questions verbally as well. I don't think so many people have any question further on these topics. Do wait for further announcements about the new seminar we will have very soon, where we will discuss other topics. We will try to organize another go-to-meeting session for economics, where we'll invite all of you, and we'll have a detailed Q&A about economics and utility of economics in financial market. Till then, it was good talking to all of you, and hopefully you will have a great